Hey Fools, Matt Copenheffer here with the Ask a Fool series. We've got a question from Facebook from James Buddy Thompson. James asks, I would like to know more about the payout ratio and how to realize a company is in danger of paying their dividend. I always hear that 75% is the high limit, but I see many companies still able to make a dividend payment with a 200% payout ratio. It's a great question. So first thing we want to think about here is what is this payout ratio that James is asking about. The payout ratio is a company's dividend divided by its net income. And the theory behind that is that the payout ratio gives you some idea of whether a company is making enough profit to be able to cover its dividend payments. So in theory, a 100% payout ratio would mean that all of the profits that the company is making are going out in the form of dividends. So if we think about, what I would call maybe a normal company, like a Procter & Gamble, James's sort of 75% rule of thumb is pretty reasonable. So a company like Procter & Gamble, they like to return a lot of their profits to investors as dividends. And so a number like 75% would return a lot of those profits, but also give a little bit of cushion there. It's very company dependent on how much a company wants to pay out and how much of a cushion it wants to keep. But for most companies, 75% I would say is reasonable to consider a high end. However, there are other companies, Verizon is a great example, the telecoms in general are a great example, that have a whole lot of depreciation expense in in the company. And what the depreciation expense is it's basically an accounting charge that you'll see on the income statement that then gets added back in on the cash flow statement. So it doesn't impact the amount of cash that the company is actually bringing in, but it does impact the accounting profit that the company makes. So when we think about the dividend payment, we want to think about how much cash the company has to pay out that dividend. And for some companies, again, like Verizon, these depreciation charges make a big difference. So the payout ratio on a net income basis is a little bit less meaningful. So James, 75%, a decent rule of thumb. But in order to get a really good sense of whether a company, particularly with a high payout ratio, is in danger of not being able to pay its dividend, you've got to look to that cash flow statement as well. Again, this is Matt Copenheffer here, and you can always read more on Fool.com.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against.